Canadian real estate investment trusts, those REITs that offer that monthly dividend, that passive income where you don't have to put up a huge down payment or, dare I say, even roll out of bed to manage it, and you're still going to collect that awesome cash flow. I thought it'd be fun today to sit down and review the best performing large cap Canadian REITs, and then we're going to review some of the underdogs, ones that might have better potential moving forward as a buying opportunity. Then, of course, we're going to take a look at a broader ETF that I came across just to see what kind of performance that can offer you. No, this will not be financial advice, but of course, I'm going to offer my opinion. And if that is something you appreciate, all I ask in return is you hit that like button. Now, we're going to start off with the best performing large caps based off the growth of their revenues not being hindered by that 2020 pandemic, guys. This really shined a light on what truly are the better performers and really making me question, honestly, my own personal REIT holdings. So let's dive right down into this with numero uno. First and foremost, the largest Canadian REIT Canada has to offer, Canadian Apartment Properties REIT, which is still a great one, by the way, and is actually still trading down from its all-time high in 2020. Actually, it's down about 5%, making me think this is a discount. I'm going to show you why. It trades on the TSE under CAR.UN, and I never initially bought this, even though it is largely exposed to apartments, primarily just residential apartments. But the two things that turned me off in the beginning was the very low starting dividend yield and the fact that they had exposure to Durham College, a lot of the colleges, all the Ontario colleges, where they're basically just renting dorm rooms and those kind of student housings, which I knew was going to get hindered in the pandemic. However, what you couldn't have anticipated is the diversification this company has provided very stable revenue growth. I mean, take a look at this revenue growth. Year over year continues to excel along with that bottom line gross profit. And if you're kind of lazy like I am, you look at the quarterly charts and you're like, damn, this is a pretty stable growing REIT. And just taking a look at their properties, guys, the diversification, muy bien. Probably one of the best ways to get exposure to those Canadian residential properties, including a little bit of global diversification. Damn, even 10% of their portfolio sits within the Netherlands, baby. Now, numero dos. Let's talk about the industrial sector. This is where we're going to be primarily living for part of this video, because let's be real, thanks to the pandemic, online shipping, people just stockpiling products. They need warehousing. They all don't buy warehousing. They find companies to rent the warehousing from. Dream Industrial, a very nice diversified one, I might say, because it also gives you a hint of exposure to the residential world with a starting yield of 4.23%, a 5-year return that matches, or dare I say actually outperforms, the S&P 500 if we plopped that dividend in there. Whoo, man, this one looking real pretty even with that starting yield. And taking a look at the growth, guys, no exception. I mean, this thing has done very well, especially from a gross profit standpoint. I mean, they've almost doubled it in less than 5 years. Beautiful, beautiful stuff. Taking a look at the quarterly here, just as good as the annual. I mean, these industrial REITs are just incredible, right? I mean, take a look at some of the diversification, because you get vast majority of your properties in Canada. Now, this matters a lot on the dividend payout, because some of these industrial REITs we're going to look at, though are Canadian companies, are too largely exposed to foreign investment properties, which means you pay foreign income tax. So luckily, this one avoids that by having the rule of over 50% of their properties in Canada. And we can kind of zoom in on this map, guys, and it just gets absolutely intense when we just kind of can zoom right in and take a look at these properties all across Canada and Ontario. This is my backyard almost. I love being able to drive out of my house and look at these real estate properties. It's one of the reasons I also love buying REITs in my backyard. Now let's talk about the third one that I do own. I do not own the other two. I wish I bought them, especially Dream, but let's talk about Granite Real Estate Investment Trust. Very similar to the U.S. counterpart Stag Industrial. I own both of these, by the way. The dividend yield starting right now, not nearly as impressive as Dream Industrial, but we're talking about 131% return. To get that extra 30% return just to lose 1.5% of a dividend, I don't think you're complaining as badly, right? And let's get right into this, because no exception. Like I said, guys, the rule of thumb, these things need to be growing revenue, growing gross profit. I mean, these are very simple metrics. You're going to want to do a lot more due diligence than me just pulling up a simple little chart here that goes, hey guys, it's going up. Obviously, do your own homework. This is just a brief overview today, guys. If you want me to do deeper dives, let me know in that comment section below and which ones. But Granite, guys, take a look at the diversification here. This is one that I was mentioning has larger global exposure, and I would not be surprised if I'm getting an extra tax that I have to pay on that dividend. But even still, guys, I mean, to get this kind of diversification, sometimes it's worth it when you can get that capital growth, which isn't taxed until you sell it, by the way. And there is no foreign tax on that capital, by the way, which is probably something you should always take into consideration. Something new that I've started looking at, that dividends, especially in REITs, might not always matter. You want that combination of growth and yield. But take a look at this, guys. Unbelievable stuff. I mean, the reason I like this one so much, you get large exposure to Amazon, 5% and growing, by the way. This has grown like year over year. Amazon just keeps expanding. They keep renting. Magna. Now, this is some of the risk that comes with this company, because of all the REITs we looked at, I think this one has probably one of the largest exposures to a single client, which does come with a little bit of risk, but also a little more stability. I mean, Magna is a good company. It is a growing company. It's a manufacturing parts company. They build auto parts for all kinds of products, and they need a lot of distribution and warehousing. So wonderful, wonderful REIT. Now, here's one I've never talked about before, but as you can tell, the cap growth, or the percentage of return, has been going up REIT over REIT. I kind of started with the worst one, worked our way up to the best one, and Summit Industrial Income just smashed it out of the water. Last 5 years, over doubled the performance of the S&P 500. A lot less of a dividend yield, so it's the give and take, right? You're giving up more cash flow, but is it worth it for that capital just going nuts here? I mean, this is crazy, right? So let's talk about this one. No exception to the rule, actually has the best growth of all the ones we looked at, but keep in mind the numbers are slightly smaller, easier for these guys to grow. And I mean, you just take a look at these numbers here, right? I mean, this one chart, it looks like Facebook almost. I mean, look at that annual chart. It almost looks like Facebook, but the numbers are tiny. Keep that in mind. It's easy to grow tiny numbers, especially in a real estate market like the industrial sector. But taking a look at this one, guys, this one's primarily purely exposed to Canada, most of it being in Ontario. So you do get that benefit, and there's nothing entertaining about these buildings. I think this is probably the most boring sector that I just keep smashing my head against the wall about, because it's crazy that these big warehousings that nobody wanted to talk about, no one cared about, have just been the best sector for the Canadian real estate market. So putting those aside, and just to reiterate, guys, we got Canadian Apartment Properties, we've got Dream Industrial REIT, Granite Real Estate Investment Trust, and Summit. Honestly, if I was going to be buying a REIT today, I'd probably start here when I was looking for some diversification. So on the other end, where might we buy some REITs that are cheaper, pay higher yields, potentially could offer growth, but historically haven't been able to do so? Let's go into that mall, condo, residential shifting kind of REITs. Many of you know them. We'll start with my favorite, the one that I own, which is RioCan, kind of the largest pure play REIT to Toronto in my favorite cities. I love driving around and looking at the real estate being constructed right now. And guys, I got to admit, I love this REIT in the crash, but sometimes you just got to admit that this one might not give you the best performance. However, I think that they are shifting. And that is something that is starting to get more aggressive amongst all these REITs we're about to talk about. But the reason these are the underrated ones is because none of these actually had growing revenue in the pandemic. And this just proves that they weren't as secure as we thought. They are going to have to shift their business models. The ones that can do this successfully, I think, are going to offer actual growth, and we might start seeing all-time highs again. And RioCan, I know they cut the dividend. I know that they sold a bunch of properties, but my goodness, the demand for what they own, and the coolest fact about REITs, and probably the worst fact about REITs, is you're exposed to publicly traded markets. It isn't expected, like a Bitcoin ETF, that the actual stock does not trade against what real estate physically does. So in Canada, the real estate market in the last year or two has pretty much doubled. And you would think that would raise the underlying value and give this company a lot more liquidity, therefore thinking the stock would go up. Even though they might have lost some tenants, the value of the real estate they own is exponentially worth more, yet it doesn't get reflected here, which could offer some undervalued potential, plus a great starting yield at 4.24%. So they're shifting from malls. They own the greatest real estate in Toronto. And on top of that, guys, I mean, moving into residential, right? Like they're sold out of their residential and condo properties for like the next 3 years. So lots of potential here, guys. Moving into the next one, smart centers. This one's really interesting because what they're doing, unlike RioCan, which is kind of building these cities and towers with like malls below them, they're taking their current malls, because they own a lot of outdoor malls. I'm sure you've seen the Smart Center logo with the penguin. They are going to be building condos and kind of miniature towns around the real estate that they own with those malls, which not only kind of supports their underlying mall potential, but also basically gives them exposure to the residential realm, and kind of do the same thing RioCan is doing, but more on the outskirts of the city where they have more liquid and better, bigger property sizes, right? And I want you to keep in mind, these things are really great from a tenant basis. I mean, RioCan and Smart Centers are largely anchored by pharmacies, liquor stores, grocery stores like Loblaws, like Walmart. This company is actually going to be headquartering a Shopify. I mean, RioCan is. So, I mean, they do have a good stable tenant basis, right? And it's not like their earnings got hit that hard in the pandemic, but hard enough they cannot make the best list, because if you can't prove the past, you're speculating on the future, in my opinion. So taking a look at H&R Real Estate Investment Trust, this is one that is largely exposed to office buildings. It was one that is still largely hindered and could be said to be trading at a discount. However, I cannot bring myself to be buying into these ones that have to make the largest shifts. The companies that I think Smart Centers and RioCan will have an easier job making the transition into more residential than something like an H&R, because when you have that real large portfolio of office buildings, which I think they just liquidated to put into residential, we're now speculating on a company to basically fulfill, especially in a tough real estate market, which they're going to be overpaying for that real estate, to kind of offer some kind of shareholder return is going to be a lot more difficult. Whereas something like RioCan and Smart Centers kind of already own the properties, and they're kind of more into the development side of it, right? So let's talk about, well, then again, I could be wrong. If you know more about HR, let me know what you think in the comment section below. I'm just kind of speaking loosely about these companies. So let's talk about the ETF. Now, I do not like Canadian real estate ETFs. I do not like Canadian financial ETFs, because the fact of the matter is there's only a handful of really big companies in each of these sectors. And you do not need to pay somebody a fee to buy 5 or 6 of the largest ones and just park them. And, you know, when one starts getting slaughtered, hopefully the other ones will make up for it. And taking a look at this one, I mean, we've drastically underperformed the market, first and foremost. 5-year return, 37% compared to the VOO's last 5-year, and compared to all those REITs, 106%. So this is what we're competing with. If I'm not going to make as much money as this, why am I taking on the extra risk, right? Just for monthly cash flow, which, you know, it's great, but it's not as good as actually, you know, having that option to sell this and making way, way more at a tax-deduced rate, because those dividends are probably taxed more than the cap gains will be in the long run. But taking a look at the holdings in this guy and the distribution, I did calculate it as around 3.5% monthly, but we're getting tapped on with a 0.75% management fee. And on top of that, guys, we've got a lot of interesting ones in here, like Tricon Residential. This one's kind of interesting. You got Summit Industrial one. We talked about Granite, Dream Industrial. It's really funny how this massive ETF is largely summed up by the companies I mentioned here. All the industrial sectors, right? We got Canadian Apartment, Killam Apartment. And again, I didn't mention a lot of these. Some of them are good. I just try to pick the ones that I like the most. But take a look at that, because these top, what, 1, 2, is there 10 here? 3, 4, 5, 6, 7, 8, 9, 10 make up 45% of the entire holdings in this. And like I said, guys, I could just copy this. With that kind of exposure is highly under-diversified. To put it in perspective, VOO top 10 holdings make up 25 to 30%. So this one is definitely largely weighted to a handful of REITs where you're paying a pretty hefty fee to invest in them. So at this point, I just want to pass the question off to you guys. What one of these do you want me to do a deeper dive on into? Because eventually what I'm thinking about doing, and I've talked about this in the past, is when I want more stability and cash flow in my life, I'm thinking about just diversifying my REITs, because right now I own like 3, and just kind of spreading them out between 5 to 6 of these. It's going to offer more stability in that cash, guys, because I did hold RioCan through the crash. It did cut its dividend. Having that much exposure that I do to that REIT obviously takes away the stability and the volatility, or adds the volatility, right? So, you know, I'm constantly evolving here. I just try and do this methodically. There is no rush. I'm just in a place where eventually, you know, stability matters a lot. So I want to pass that question off to you. What do you guys think? Stay cool, stay awesome, and I look forward to catching you in the next one.